So now the part of the show that I talk about what I believe is important for individual investors to consider over the next 10 business days. So three things that I think are important for individual investors to consider over the next couple of weeks. And you can see them here. They are Fed speak. Federal Reserve has a meeting today, 2 p.m. They'll talk about interest rates and interest rate setting policy. Corporate earnings. We're in the heart of corporate earnings. This week is actually the busiest week for corporate earnings in the United States, and we're obviously about halfway through. Lastly, but definitely not least, economic data. Looking at data from 30,000 feet. So we're talking about macro data and how that will affect the stock market and stock market movements. So the first topic, or I guess point, Fed speak. And I thought I'd start with Fed speak, as I said, because today we do have a meeting at 2 p.m. The Federal Reserve will announce what they're going to do with interest rates. Now, I don't believe anybody believes that they will cut interest rates today, nor will they raise interest rates today either. But I think we're all going to be listening for where the bias lies. Will the Fed still say that they're waiting to cut rates and it's still only a matter of time, and based on economic data, the next move in interest rates will be to the downside? Or will they say for the first time in quite some time that they could actually consider raising interest rates because inflation in the US has been or has remained stubbornly above their 2% target? So a lot of people are going to be looking for what the Fed says. Will they be hawkish, leaning more towards keeping things where they are, higher rates for longer, or maybe even an interest rate increase? Or will they hint or continue to talk about a point in time where they can cut rates, because interest rates definitely are on the high side, especially when you consider interest rates in the US, Fed funds rate above 5%, when inflation, even though it's been creeping up, still below 4%. So there is still a pretty large gap there. So it'll be very interesting to see what the Fed says, but not only just the Fed governors in general. Once the Fed speaks today at 2 p.m., all the Fed officials will be free to go to the press. All the different Fed heads from all the different offices across the United States, Chicago, San Francisco, New York Fed, they'll talk about what they believe and what they think is important with respect to interest rates. So first chart that we have here, Fed funds target rate. We've shown this in the past. You can see pretty much a spike higher over the past couple of years. And I would say over the last 6 months to 12 months, you've seen a flattening out, no more interest rate increases. And we haven't seen any interest rate decreases as yet, but because Fed officials have been saying that inflation has remained stubbornly high, even though it's come down from 9% in the US, they're still not happy because they want to see a 2% inflation rate. And until they see at least a path to 2%, or things moving towards 2%, they're not about to lower interest rates. A second and third chart, actually, we have charts together with respect to, well, you can see it here, the dream of Fed interest rate cuts slipping away. And that's mainly for this year, I would say. Hopefully, we can still see at least one, maybe squeeze in a second interest rate cut, but it's looking less and less likely, and perhaps interest rate cuts may not happen until 2025. On the left-hand side of the chart, you can see real GDP growth in the 2023 staying very, very high. You could see that in the latter half of the year, GDP really spiked higher. In 2024, in the beginning of the year, you can see it coming down, but still staying in between 1.5–2%. GDP in our country has been coming in at around 1–1.5% for a little while now. Predictions are actually that we will see perhaps maybe even a 2.5% GDP growth number this year. So again, maybe that gives the Bank of Canada some time before they want to cut rates as well. On the right-hand side of this chart, which I think is more important than the left, is core PCE. Remember, PCE is basically a measurement that the Fed uses to look at inflation, personal consumption and expenditures. That's what it stands for. It doesn't really factor in as much of the shelter prices as CPI, Consumer Price Index, does. So takes away a little bit of the shelter, which we know shelter housing prices have been really high. And you can see here that core PCE year over year is still sort of coming down, maybe flattening out. That's the lighter line. And the darker line, the blue line, is more on a quarterly change basis, quarterly change annualized. And you can see how it shot up recently. So with that in mind, I don't believe that the Fed will be in a position or wants to be in a position to cut rates. Well, I should say they want to be able to cut rates, but don't think that they will be in a position to do so over at least the next few meetings. We're now seeing that an interest rate cut may not happen until all the way to December. And December is the first time we see the chances above 50% that we will have a rate cut. So let's hear what the Fed says at 2 o'clock today. Let's try and parse through what Fed officials will say in the coming weeks after the news release this afternoon, interest rate setting policy this afternoon. And I think individual investors need to be mindful of that. The second point I wanted to touch on is corporate earnings. And as I said, we are in the heart of corporate earnings. And if you have a diversified portfolio out of different types of stocks and bonds and mutual funds, perhaps, et cetera, you're looking at what these companies are reporting. And for the most part, corporate earnings have been really, really good. And we've seen a number of the big cap tech names come through with good earnings. A couple of them disappointing earnings. Tesla comes to mind on the disappointing earnings side. But for the most part, the other big cap Magnificent Seven names have really done well. And we're seeing really companies right across the board do well, not just in tech. We're seeing on average 70, 75% of the companies that have reported are beating expectations. So that's a good thing. We have a couple of charts here to show you. One is Alphabet, or we know it as Google, at least I still call it Google. And you can see here that that spike that you see on the right-hand side of the chart, that is right after they reported earnings. And if you're wondering why you see a downward trend, well, that was more to do with macro data that came out, inflation data that was a little warmer that came out right after the earnings. So we saw a spike in Google, reported phenomenal earnings, probably the best earnings out of any company that I've seen so far for this quarterly reporting season. And unfortunately, the macro data took down their price a little bit, but still above where it was prior to the corporate earning, prior to them releasing corporate earnings. A second chart we have here, Eli Lilly. Now, for those of you that don't know Eli Lilly is a U.S. pharmaceutical company. You may have heard that them, along with other company, Novo Nordisk, Ozempic, perhaps that rings a bell. They're into the weight loss drugs. Originally started off as diabetes drugs, but then quickly realized that people can lose weight if they're on these drugs. And they started to make versions of the drug specifically for weight loss. And Eli Lilly has never looked back, has shot up. And we're starting to learn that these drugs can also be used for things such as addictions, drug addiction or alcohol addictions. And so we're starting to hear that Eli Lilly is getting into that area of research. So a lot of things coming down the pipe in Eli Lilly, diabetes drugs, weight loss drugs, Alzheimer's. They're looking at that as well as a possible drug to slow down Alzheimer's in general. So Eli Lilly, you can see how well the stock has done. You can see here up $42 on the day it reported earnings. Some are actually calling Eli Lilly the NVIDIA of pharmaceuticals, of the pharmaceutical sector, because how fast it's gone up. Almost $1 trillion market cap, by far the largest pharmaceutical company in North America, one of the largest in the world today, if not the largest. So corporate earnings, very important. We've seen a lot of companies do well, and a lot of companies, unfortunately, not do well. Starbucks comes to mind. They reported earnings not so well. McDonald's, not so well. CVS, the pharmacy company in the United States, really disappointing earnings. Saw their stock fall more than 15%. So again, we do have, I guess, a mix of those doing well, those that are not. Some of them are in the same sector, Eli Lilly, Pfizer, Pharma, that's doing well. And then there are some that haven't done as well. So corporate earnings is something that I think individual investors obviously need to focus on. The third point and last point I wanted to make is economic data. What is the economic data individual investors need to focus on? Well, a lot of economic data has come out recently. We've seen, as I said, GDP falling down to 1.6% in the US. But coming up on Friday, we're going to have a big report. It's the jobs data. And that's the first thing I wanted to discuss. Job creation in the US. We saw in the month of March, job creation was above 300,000. We have a chart that shows you the job creation in the US, monthly jobs. There you have it. And you can see that in March, it had the highest number. You can go back all the way, I guess, into the spring of 2023. So a year ago, since we saw such strong job creation for the month of March. Individuals are expecting jobs growth to become slower in the US. We saw what we call ADP, private payrolls today out of the US, again, beating slightly on the expectations. So we'll see what the jobs number reports or what the jobs number tells us on Friday, but it will definitely be a market mover. If we see something too strong, then perhaps the market says, well, chances of rate cuts are just getting pushed further and further away. If we see something too small, then perhaps people start to think that maybe the economy is slowing down. So once again, we need a number somewhere in between, something just right. Next chart we have actually is on real gross domestic product, GDP, out of the US, again, 1.6%. And you can see a nice fall from where it was in Q3, Q4, and now Q1 here in 2024. Definitely unexpected. GDP slowing down. Keep an eye on that. If we continue to see growth slowing in the US, getting closer to that flat line, perhaps that is a signal for the Fed. And perhaps the Fed should take a look more at the slowing economy, why it's happening, and maybe consider interest rate cuts sooner than later. Not sure, but definitely GDP is a signal to investors and one that should be watched. Another economic point or a piece of data that came out recently, something I don't talk about often, and it's the employment cost index. And we have a chart on that. Now, the employment cost index, pretty simply, is the cost that employers face. So primarily wages, wage increases. And you can see how in the far right-hand side that the employment cost index has gone up. It actually went up this last reading unexpectedly, higher than anticipated. And on that day, we saw the market sell off. I think the Dow was down 400 points a couple of days ago. The NASDAQ was down because wage inflation is something that's obviously very real and keeping the overall inflation rate from falling significantly. So wage inflation coupled with services inflation, people are spending money today on experiences, and that's keeping inflation high in certain parts of the economy, and it's keeping the Fed from raising interest rates. So overall, what do you need to be looking at? Well, as I said, you want to be looking at the economic data, so the macro part, the corporate earnings, which is more micro in nature, and you want to listen for what the Federal Reserve governors are going to be saying over the next couple of weeks so that we can understand if an interest rate cut is perhaps coming down the road this year or maybe even pushed off to next year. And I think if you factor in those 3 points, you hopefully will get more of an understanding as to how you should build out your investment portfolio today.